Historically, the formula for the Indian economy has been painfully simple. When conflict erupts in the Middle East and oil prices spike, domestic growth grinds to a halt. The math is brutal, and the panic is usually immediate. By May of 2026, that exact trigger had been pulled. The escalating conflict between the US and Iran pushed Brent crude oil securely past the threshold of $100 a barrel. The global markets reacted exactly as the historical playbook dictated. Foreign institutional investors aggressively dumped 2.2 lakh crore rupees worth of Indian equities, fleeing the region to divert their capital into US-based AI companies. That wholesale exit of capital hit the currency markets hard. By mid-May, the rupee crossed 96 against the dollar, flirting with the psychological 100 mark. High crude oil prices, severe capital flight, and extreme currency depreciation should create an economy in freefall. Instead, India's GDP growth is holding at a robust 6.9%. Invest India has successfully grounded $6.1 billion in foreign projects, and the National Stock Exchange is actively preparing an initial public offering worth $2.5 billion. The traditional models cannot explain this divergence. We are watching foreign capital flee and the currency plummet, while the domestic economy simultaneously hosts one of its largest wealth generation events on record. To understand exactly how that is mathematically possible, we have to follow where the money is actually moving. India's structural vulnerability comes down to the sheer volume of fuel it imports. When crude hits $100 a barrel, it triggers a widening trade deficit. Buying that expensive oil means physically draining reserves of US dollars out of the domestic economy. In 2026, that dollar drain is happening through two distinct channels at the exact same time. Importers are sending dollars out to buy overpriced crude, while foreign investors are cashing out their equity holdings and taking their dollars back to the US. This chart shows the rupee's depreciation is a uniform trend, rising sharply against the dollar, euro, and pound. This prolonged weakness creates severe cost pressures. For domestic sectors dependent on crude derivatives, like auto, FMCG, and paint companies, import costs surge and profit margins evaporate. If you stop analyzing the market here, you see severe structural pain. But stopping here misses the active institutional counterattack happening beneath the surface. The Reserve Bank of India is not watching passively. They are actively deploying deep currency reserves to defend the rupee and absorb the global shock. Their immediate tactical response has been aggressive. The RBI is heavily dumping dollars into the spot market to meet importer demand, and recently executed a $5 billion buy-sell swap auction. This strategy instantly injects much-needed rupee liquidity into the banking system without permanently depleting their reserves. If the spot market interventions aren't enough, the RBI holds a broad tactical arsenal in reserve. They can deploy targeted capital flow management measures, like specialized deposit schemes to draw in billions of dollars directly from non-resident Indians, or issuing sovereign bonds. These aren't theoretical concepts. The RBI used these exact tools to successfully mobilize offshore capital during the 1998 Asian financial crisis and 2013 taper tantrum. By utilizing aggressive liquidity tools, the RBI is deliberately setting a hard floor. They are buying the domestic market the time it needs to absorb the global oil shock, while fighting to keep the exchange rate from breaking the under 100 rupee threshold. While the RBI defends the currency, domestic investors are executing a highly strategic maneuver. Rather than panicking and fleeing the market alongside foreign institutions, they are rotating their capital. Capital is flooding into sectors insulated from global shocks. The first major safe haven is defense. Investors are pouring money into domestic companies developing AI-enabled autonomous platforms, drone swarms, and advanced electronic warfare capabilities. The second major safe haven is energy security. With the country heavily exposed to imported crude, billions are moving into domestic data infrastructure, electric vehicles, and nuclear capacity, which is projected to nearly triple over the next 6 years. The US-Iran conflict has done something unexpected to the Indian market. It turned the concept of industrial self-reliance from a political talking point into the most profitable, highly capitalized investment theme of 2026. The combination of the RBI's currency stabilization and this significant capital realignment provides the foundation for the ultimate test of market resilience, the National Stock Exchange IPO. The exchange is targeting a June window to file its draft prospectus. Existing shareholders will offload over 4% of their stake in an offer for sale. Depending on final valuations, this transaction will pull in approximately 23,000 crore rupees, making it one of the largest public offerings in Indian history. Just over a decade ago, this scenario was impossible. A Middle East war, oil breaching $100, and a rapidly depreciating currency would have instantly frozen a public offering of this magnitude. The fact that a 23,000 crore rupee IPO is proceeding on schedule proves that the domestic capital pool is now deep enough to absorb billions in foreign exits without collapsing. Headline panic often masks underlying wealth transfers. Surviving and thriving in the 2026 economy requires identifying the specific sectors built to defend against global volatility.